Okay, we've got a genuinely fascinating mystery on our hands today. We're looking at Western Digital, ticker symbol WDC, and something here, well, it just doesn't add up. Usually, when a company reports absolutely extraordinary financial improvements, the market rewards it, right? But right now, we're seeing Western Digital stock go through this violent, jarring pullback at the exact same time its underlying business looks stronger than ever. So, how on earth can a company be producing record-breaking numbers while its stock basically falls off a cliff? I mean, the market has been absolutely punishing this stock recently. Western Digital just fell more than 5% in a single day. Over 1 week, that decline reached almost 19%. And if we zoom out to a single month, we're looking at a brutal drop of over 22%. When you see a sea of red like that, naturally, as investors, you've got to ask, what exactly broke here? Did the business fundamentally fracture overnight? But here's where the story completely separates itself from your run-of-the-mill market sell-off. Over the previous year, this stock was showing a jaw-dropping gain of over 960%. Actually, Western Digital didn't just have a good year, they just reported $12.9 billion in fiscal year revenue. That is a massive, massive influx of cash. So why is the stock falling? If the revenue is there and the growth is clearly there, what exactly is Wall Street seeing that we aren't? Is the market simply taking profits after a historic run? Is the much-hyped AI storage boom already perfectly priced in? Or is there something highly dangerous buried underneath these headline numbers? Well, before we can answer that, we need to completely rethink what this company actually does. Section 1. The AI storage boom and moving beyond processors. When we talk about AI, our brains instantly go to processors and GPUs, right? NVIDIA, AMD, the usual suspects. But investors constantly overlook the real engine of the AI revolution that's happening right behind the scenes. Think about it. Step 1, AI creates an unfathomable amount of new data. Step 2, all that data requires vastly more physical storage capacity. And step 3, this creates a massive demand for high-capacity drives. AI needs a physical place to actually store what it generates, and Western Digital builds that exact infrastructure. But is the company truly capturing this value, or are investors just blindly attaching the letters AI to the stock and hoping for the best? Let's move to Section 2, Unpacking the Financial Evidence, looking at the fiscal year 2026 numbers. If we want to know if they're truly capturing the AI wave, the proof is right here in the accounting. And honestly, this makes the situation very uncomfortable for market bears. The sheer scale of this explosion is just overwhelming. Revenue jumped 36% to almost $13 billion. But look a little deeper. Operating income grew by 91%. Gross margin expanded by an incredible 1,010 basis points. That is a massive 10 percentage point leap. And the bottom line? A 481% reported increase in net income, driving GAAP EPS up 446% to $24.28. When earnings explode like this, you really have to ask yourself what triggered it, and more importantly, can it possibly last? To figure out if it can last, we need to look for a pattern. Notice the progression throughout fiscal 2026. $3.02 billion in Q2, $3.34 billion in Q3, jumping to $3.75 billion in Q4. Growth wasn't collapsing as the year progressed, it was actually accelerating. This establishes our first major contradiction. The operating business is objectively getting stronger, quarter by quarter, and yet the stock is falling sharply. Make it make sense. Well, to solve this contradiction, we have to shift our investigation from the income statement directly to cash. You know, earnings can be manipulated with clever accounting, but cash is undeniable. In the fourth quarter alone, Western Digital generated an astonishing $1.28 billion in free cash flow. This fundamentally changes the entire story. We aren't just talking about AI hype anymore. They're converting excitement into enormous, tangible cash generation. But that brings us to the most dangerous word in the storage industry. Section 3, the cyclicality trap, or what happens when growth normalizes. Let's introduce our primary suspect for the stock's sudden decline. The storage industry is notoriously cyclical. Think of it like selling winter coats. Demand booms when it's freezing and then completely evaporates in the spring. It's prone to massive repeating swings in pricing and supply. Customers will suddenly hoard inventory and then just as suddenly stop buying entirely. So when Western Digital's margins jump from around 38% to nearly 49%, the question isn't whether they can earn that today. The real question is, can they earn anything close to that when the inevitable storage cycle finally turns?
Seriously, what happens if AI spending slows? What if hyperscalers suddenly reduce their capital spending? What if customers need a full year just to digest the enormous storage capacity they've already bought? Or what if new SSD technology starts taking market share away from Western Digital's legacy hard drives? If growth simply normalizes, Western Digital faces a double threat here. Their earnings could collapse, and the valuation multiple that investors are willing to pay will collapse right alongside it. It's a dangerous combo.
Now, management is certainly trying to project confidence. They recently bumped the quarterly dividend by 20%, bringing it to an annualized 60 cents per share. But as an investor, do not confuse a dividend with absolute safety. For a highly cyclical company, a large debt burden becomes incredibly dangerous if demand slows. You've got to ruthlessly scrutinize their total debt, interest expenses, and maturities right now, while this cycle is incredibly strong, not later when it turns against them. This reveals the psychological trap set by that massive 960% historical gain we talked about earlier. Is Western Digital cheap after a 22% drop? Well, enormous past gains create severely elevated expectations. Investors see a stock that has multiplied and just assume it's going to keep going up forever. When expectations are sky high, even record-breaking earnings can somehow disappoint Wall Street. Figuring out its true valuation in this environment becomes incredibly tricky. Section 4, Bull versus Bear, the competing narratives. How you view the stock entirely depends on which of these two stories you believe will ultimately play out. The bull case relies on a structural shift, the idea that AI data growth is permanent, with record revenue, massive cash flow, and management projecting up to 49% revenue growth for Q1 of fiscal 2027. The long-term story looks basically unstoppable. But we have to weigh that against the bear case. The storage cycle historically always reverses. Always. If AI CapEx slows down and competitors flood the market, Western Digital is going to suffer. And honestly, the company doesn't even have to fail. It just has to grow less spectacularly than the market demands for the stock to get crushed. Section 5, the final verdict and the investor's scorecard. Bringing all these clues together, we're left with a fascinating balance of extreme greens and extreme reds. The business fundamentals? Phenomenal. Revenue, earnings, and free cash flow are all ranging from excellent to exceptional. AI is clearly creating a structural opportunity for them. But look at the risk side of the scorecard. Cyclicality remains a major looming threat. Margin sustainability is absolutely critical. And because expectations are so heavily inflated from their past run, the short-term risk to the stock price remains exceptionally high. Therefore, my final classification for this explainer is watch, with a selective buy approach. Look, this is not a broken business. They're posting incredibly impressive numbers. But you absolutely shouldn't blindly chase this fallen stock price just because it dropped 20%. Instead, be incredibly strict. Monitor their revenue growth, watch exactly where their normalized margins settle, and track that free cash flow like a hawk. If those three metrics remain strong while the valuation cools off, that is when the buy case becomes truly compelling. Until then, keep it firmly on the watch list. And that leads us to a really fascinating question that bridges perfectly to our next topic. Because Western Digital's problem is deciding if extraordinary growth can continue. But the next mega-cap tech company we're investigating has a completely different mystery. Its business is enormous, its technology is absolutely critical to the modern world, and yet it's facing a massive pricing crisis. Is the market just seeing a slowdown before the earnings even arrive? Or is it creating a generational opportunity that nobody wants to touch yet? That's our next investigation, and I will see you there.